Hi, this is Shane with the Russian Trader. It is Thursday the 25th, plus a little bit more than 600 today. Nothing in the yen or gold. The yen yesterday, we missed that nice down move because we didn't get filled. No trades today in either of these markets. In the euro, we had, you can see here there's a no fill again. All right, that's going to scratch. But then also back here, a little faster, please. I'm sorry, it's right here. We short there and then scratch there as the market continues to kind of slowly grind up and not roll over until later. So that's it in the euro. In oil, we short here and catch a 60 tick move. So there's a fair amount to talk about here. There was an earlier long here that scratches, right there. So we're trailing. We move the stop at 10 at plus 10, and then we trail by 20 once we get to 20. So on the short here, this is actually a trade that we just added because what we've been doing is targeting a fewer number of trades, but still trying to afford ourselves the opportunity to catch this kind of move, so we don't get eaten alive by costs. And I had tuned that, I think, a little too low based upon the first 2 weeks of April, or the first 3 weeks of April, and so I redid that analysis and changed it, and I talked about that in a video a couple days back, I guess. And so this is actually one of the trades that got added, was this 151 short. And so we catch that move, get filled, and then it falls. The target is 60, and that looks like a pretty magical exit. You'll hear me say that there's some element of luck involved in an exit that good. It's true. At the same time, it's not a random number. All right. Now let's be clear. It's not the machine learning system deciding that it's now time to get out. That's not what's happening. The machine learning system is working up here, finding that signal. There's a very sophisticated deep learning network involved to find that signal. But this is not the choice of 60 ticks as the target is not random either. So what I do is I run, once I have the model that I use, I run simulations against, well, it's actually part of the same process that, let's see, is it right here? Yeah, part of the same process that I use to create, this set of codes to trade, which is now targeting trades per day. That same analysis, I then take these codes and I run simulations on them at different target levels to find the optimal one. And it's not difficult to do once you have the program, right? The simulation runs in about 15 seconds, and you run it at 50 ticks, you run it at 100, you run it at 75, you run it at 90, yada, yada, yada. And you just target down 60 ticks, right? Years ago when I traded oil, when oil was back above $100 a barrel, or rather trading in a range between like 80 and 110, my default target was 100 ticks. Now it's 60 because the market doesn't move as much. All right, so I want to be clear that there's not a machine learning choice being made here to exit, but it's not random either. Okay. Now, there's two other things to talk about here. We are actively trying to reduce the number of trades while still catch this kind of move. Okay. So I retuned that starting Monday, but then I made some rather foolish mistakes and was actually not trading live Monday. So when we look at the trade activity log, on Monday and Tuesday, I didn't actually trade live. Wednesday, there were no trades. And so the only trade since the 21st is this trade, 610. So on two trades, right? The first trade was a scratch today. nevertheless, what we saw prior, prior to this tuning was even fewer trades. So the question now is, if I showed you going back to the beginning of April, there were only like 2 or 3 other trades because it was just tuned too conservatively, right? So what we need to do now is continue along this path and see, all right, well, do we catch a move like this frequently enough with being as choosy as we are, or is this just a random one-off and we won't see it again for 6 months? We don't know that yet. The simulations and the model building all suggest that yes, we will see this on, you can't say a regular basis because there's a lot of randomness in the market, but we will see it enough that it makes it worthwhile to trade. All right, but now we have to actually do it. So let's look at the other markets real quick, and then there's one other thing to talk about related to how to trade a single market. If we look at, actually, I did want to show. Hold on, trade. I did want to show the trade management and the targets for oil. So you can see the target is 60 ticks, which, as we saw, that's a pretty amazing exit. And again, it's not a machine learning choice to exit, but it's not random either. There's a lot of analysis that went into that number. And then we, in terms of the stops at +10, we move to entry +1. Just so you get 10 ticks, and now you're going to scratch. We don't do anything. I don't even need this step 2. And then at 20, we start to trail by 20. Okay. I should mention one other thing. It's kind of the traditional way of looking at a move like this is you expect to catch half of it, because it takes a quarter of the move to understand that there's a move underway, and then it takes another quarter of the move to understand that it's over. So you end up getting half. So if you get anything more than half, you did well. Here we got almost this entire chunk here. Now you could consider that the market did continue lower and look at the entire amount from here to here. All right. I don't think that's reasonable, because that's a really deep pullback, and almost everyone's going to be getting out there. So it's your mileage may vary. That's my opinion. Okay. Now the euro. Let's look at the euro trade activity. So this is again just for this week, and so we were down 1 trade on yesterday, and then one scratch today. I did run when I discovered that I had screwed up the auto trading, and all I had done is I'd failed to I had failed to click this button right here that says turn on the auto trading. It's also up here, right there. I just didn't do that Sunday for some reason. It's set that when you open the software, you're not auto trading, and that's the correct thing to do. You have to remember to turn it on. But what I did is I ran a simulation, or I'm sorry, a replay to see, what did I miss or not, and it wasn't. And that's in a video on. I think that's Wednesday's video. You can go back and look at that if you like. There was nothing major. I had gold made 6 ticks or $60, and the euro was down, I think 1 trade, so that's $44. So up a little bit, down probably with cost, because I think there was 1 gold trade and 2 euros. Okay, so just you can again, the point here is that we're trying to reduce the number of trades, and we're succeeding in that respect. The question is, are we able to catch enough of these nice moves like this? All right. Now, let's talk about single market versus multi-market, because what I have in my head is that if I trade multiple markets like this, I need to do what I'm doing, which is get very choosy with the trades I'm willing to take, and just I'm willing to miss moves in markets because I'm trading a bunch of different markets. And that changes the analysis to focus on, this value, trades per day. That's actually, you can see it. This is the actual output of the program. Trades per day is right here. So the focus is I want trades per day at a certain level with a certain, with trades that are at a certain quality level. All right. And what I have in my head is that if I want to trade multiple markets, I need to do that. But if I wanted to trade a single market, then I should do the other method, which is focusing on just the risk factor. So this is going to afford you a lot more opportunity to participate in the market, but you're going to take more risk. All right. So you can see actually that this is a subset of this, right? There's an extra couple of short trades, and then there's 5 extra longs here. But the risk factor is high. It's 30%. That's means 1/3 of the time you're going to take a max loss, or two trades in a row without a profitable trade that day. All right, and that's how I would typically trade a single market. But you know what? As long as you're patient, and since you don't have to sit here, the auto trading system does the trading for you. Why do it this way? Unless it's dramatically more profitable, because you're gonna take a lot more trades, you're gonna take a lot more losses. All right, that's trading, right? Each of those trades has a cost, and so it occurs to me that maybe you can just use actually this was spelled wrong. You could actually trade a single market using the multi-market approach, because all you have to do is catch even just one of these moves a month, and that's a pretty good return if you think it through. This is modeled on CL. If you just work out the math, we're taking 7 ticks of risk per trade, and we'll take 2 of those a day. So max loss per day is $140. Now I haven't actually seen that because I'm so choosy, but that's the theoretical max. All right, so we calculate how big an account you need based on that number. So you could do what I'm doing here, trading oil with a $5,000 account, and trade this multi-market, this here, this set of columns. And all you have to do is catch that one trade per month. You just have to be patient. And I think this is a problem that people have, is that they look at the charts and they go, there was this move I missed, and they're impatient. They want to have participated in that move, right? So there's some element of greed there. Some of that is anxiety that you missed that move and you're not going to catch the next one yet, and pretty soon that just spirals out of control inside your head. And so I'm thinking about that now. I wasn't thinking that way before. I was thinking single market. You should, you want to take more trades, take more risk, and etc. But the reality is, it only takes, if you're able to keep the number of trades down, like we're seeing here, and you catch a nice move, you only need one a month to have made it worth your while. You really only need one. So we'll see. We need actual live data, and unfortunately, this is one of those things where it doesn't matter what the simulation shows. It doesn't matter what the testing shows or what the analysis shows. You now have to do it live, and that means in real time, and it takes time to do that. So I can't just push a button and go, oh yeah, this is the way to go. I can push a button and say the analysis suggests that this is how we should do this moving forward, and I'm doing that in a way that is as realistic as possible in terms of making sure that I'm not curve fitting the data to the market. All right. So there's other videos that describe how we make sure that we're running a simulation on machine learning predictions, where the machine learning is trained on data the machine learning is making trades on data it's never seen before. So it's a true test. So we'll again, I'm starting to ramble now, but we'll see. We need to just continue doing what we're doing here. Up next for me is a sort of the results of an analysis of how frequently do you need to update the model. So we've been updating it every week, and I'm seeing that actually introduces some variation which I would prefer not to have. And so less frequent model updates look like the way to go. I need to actually, I can quantify that, so I'm working on that. And then basically what that means is that instead of a model coming out every week, let's say it comes out every month, when it comes out, it comes out with a new set or a new analysis that we would expect to see a similar sets of codes, but you might see some differences, right, as more data is built into the model. Okay, so this is the other thing on my mind is model-to-model variation and how often you have to update it. Okay, all right, so that is it for today. 61 ticks in oil, good day. Scratching in the euro and nothing in these other two markets.